Welcome to the Deep Dive. Today we're jumping into a really fascinating earnings call from Green Plains, or GPRE, looking at their Q3 2025 results.
Yeah.
And this wasn't just, a standard quarterly update. This felt like a company announcing a whole new identity.
It really was. I mean, this is that inflection point we've been watching for. They're finally cleaning up the balance sheet, a huge debt restructuring, and at the same time, they're flipping the switch on their carbon capture tech.
So they've stopped playing defense.
Exactly. They're officially on offense now.
So our mission today is to figure out how they pulled this off. I mean, we're talking operational records, getting rid of a ton of expensive debt, and making this huge pivot from a commodity ethanol producer to a low-carbon fuel platform.
And the question is, did the numbers actually back up that huge story?
Let's start right there, the financials, because they kind of present a puzzle right away.
They do. So the big headline number, the one that got everyone's attention, was the bottom line. GAAP EPS came in at 17 cents.
Okay, and for context, what was the street expecting?
The street was modeling a loss, something around negative 3 cents a share. So this wasn't just a beat, it was a massive positive surprise, like a 25-cent beat per share.
Wow. And what about when you strip out all the one-time stuff, the adjusted numbers?
They held up too. Adjusted EPS was about 7 cents when consensus was looking for a loss of 7 cents. So again, a huge beat. They made money when everyone thought they were going to lose it.
But there's always a but. The top line, the revenue, that told a totally different story.
Yeah, that's the complicating factor. Revenue was a definite miss. It landed at about $508 million.
And Wall Street was looking for?
Closer to 580, 590 million. So it was a pretty significant shortfall, about 12%.
Wait, a 12% revenue miss is huge. How on earth do you go from that kind of weakness on the top line to a massive beat on profit? I mean, what's going on there?
Well, it's a mix of some smart financial moves and just incredible operational performance. The key profit metric to look at is adjusted EBITDA. It's basically flat year over year, 52.6 million. And management said that stability came from two things. First, the very first impact of the new 45Z clean fuel tax credits.
Right, the government-backed revenue stream.
Exactly. And second, just unbelievable performance on their crush margins internally, which totally offset that soft commodity market.
So that profit stability, even with lower volume, that's what signaled the market that the business is fundamentally changing.
Yes, that's why the stock popped, even with that revenue miss. And when you dig into the balance sheet cleanup, you see why it was justified.
Okay, let's unpack that. The financial restructuring. This feels like the big de-risking event. What did they actually do?
They took a big one-time hit, a $35.7 million non-recurring interest expense.
And that was to get rid of what?
To extinguish their really expensive junior mezzanine notes. Think of this as like high-interest emergency debt that was just dragging them down.
That's a huge charge. How did they swallow that without the whole quarter just turning into a massive loss?
This is the clever part. They almost perfectly offset it. That $35.7 million charge was covered by a $36 million gain from selling their plant in Obion, Tennessee.
Ah, so they sold an asset.
Right. For $170 million in cash, plus working capital. So they used an asset gain to cancel out the accounting hit from cleaning up their debt. Really smart.
So what was the net effect on their total debt?
The total debt load dropped by over $220 million since the start of the year. And crucially, they got rid of their near-term maturity risk. They paid down that expensive debt and then swapped their 2027 notes for new ones that don't mature until 2030.
They bought themselves a ton of breathing room.
A ton. Years of runway.
So the financial side is reset. But now for the exciting part, the operations. Because you can't have a growth story if your plants aren't running well.
And they are running incredibly well. The entire network hit over 101% capacity utilization in Q3.
Hold on, 101%. How is that even possible? Are they just running the machines into the ground?
It sounds like it, right? But it speaks to a level of optimization they haven't seen in over a decade. They said it was just basic blocking and tackling, technical improvements that led to record or near record yields on everything. Ethanol, corn oil, protein.
They're just squeezing more value out of every single bushel of corn.
Exactly. And that efficiency meant that even though their production volume was actually down,
right, about 10% year over year,
their consolidated ethanol crush margin still went up slightly to 59.6 million. The higher yields made up for the lower volume.
Which brings us to the core of the new strategy, the carbon play. The whole reason this company is changing.
Yes. Let's talk 45Z and the carbon capture, or CCS, strategy.
This quarter, we saw the first real money from it. The monetization went live.
It did. They recognized $25 million of 45Z credit value in Q3. And that's real cash visibility, coming from a deal they already have in place with Freepoint.
And they gave guidance on that going forward, which is what investors need to see.
Yep. They said they expect another 15 to 25 million of incremental 45Z money in Q4 alone. And they can be that confident because the actual physical pipes are working.
Okay, what's the status on that, the physical pipeline?
All three of their Nebraska plants, that's York, Central City, and Wood River, are now either fully commissioned or are actively ramping up QU deliveries into the Tallgrass Trailblazer pipeline.
So it's not just a concept anymore. They're actually capturing and moving carbon.
It's happening. And that is what underpins this massive long-term goal they've laid out.
And what is that ultimate number? If they get the whole fleet up and running and qualified?
They're targeting about $188 million in annual carbon credit earnings. If they hit that, it's not just a boost. It completely changes the entire company's valuation.
That number sounds almost too good to be true, and I'm guessing the market is still pretty skeptical that they can pull it off.
Oh, absolutely. The skepticism is real and is why the stock is so complicated right now. So on the 45Z potential outside of Nebraska, they did adjust that down a bit.
Why?
Because they sold the Obion plant. So the potential from the non-pipeline plants is now around 38 million, down from 50. And that's all contingent on hitting really strict carbon intensity scores.
So they have to keep investing in getting greener.
Absolutely. Their new capital policy is all about that. First, internal projects to improve throughput and lower their carbon score. Then, paying down debt. And only then, way down the line, returning capital to shareholders. The priority is technology.
Okay, so let's zoom out. You have this incredible quarter, operationally and financially, but the stock, it didn't really hold its gains.
And that's the disconnect, right? The stock rallied, 12.6% on the day of the announcement, but since then it's basically drifted right back down.
So investors are still worried. What are the big risks that have analysts sitting on a hold rating?
It's really a single lever policy play now. The biggest risk is the stability of that Section 45Z credit itself. It's the central pillar of their entire model. If that policy gets challenged or isn't extended,
That whole thing falls apart.
the whole valuation model collapses. And then there are a couple of internal execution risks.
Like what?
Well, first, there's still a bit of debt to watch, about 117 million in carbon equipment liabilities that are about to get reclassified as long-term debt.
Okay.
And second is the pipeline timing. Management admitted there's a slight delay between when they capture the Kio Euro in Nebraska and when the wells in Wyoming actually inject it. They say they're confident in their partners, but any delay, that feeds the skepticism.
Okay, so now for the part of the deep dive where we put on our outrageous but plausible hats. And a reminder, this is absolutely not financial advice, just a hypothetical thought experiment.
The setup here is just perfect for it. GPRE has incredibly high implied volatility, around 70%.
So the market is pricing in a really high chance of a massive price swing.
Exactly. The cost to insure against a crash is really high. But at the same time, they just finished all their defensive moves with the debt cleanup, and they're running at record operational levels. The volatility is purely about policy uncertainty.
And if you believe that the 101% utilization creates a kind of hard floor under the stock,
then the market might be overpricing that crash risk. So the trade idea is to basically bet against that volatility. You sell that expensive crash insurance while staying long the stock itself. You're betting that the strong operations and the cash coming in from 45Z will trump the policy fears, at least in the short term.
okay, so what's the actual action? How would you do that?
You'd buy the common stock, so you're exposed to the upside from the low carbon story. But at the same time, you use that high volatility to your advantage by selling an out-of-the-money put option.
So you're selling someone the right to sell you the stock at a lower price.
Right. And you collect a nice chunk of cash, a premium for doing that. We'd probably target an expiration date just after the Q4 earnings report.
So you collect that premium upfront, it lowers your cost basis on the stock you bought, and you're betting the company's operational floor holds and the stock doesn't collapse before the next report.
That's the trade. You're getting paid to take on the risk that the stock won't fall off a cliff. But you have to remember, if something bad happens with the 45Z policy or the pipeline, that floor could disappear very, very quickly.
So let's bring it all home. This deep dive shows a company that really did two massive things in one quarter. They reset their balance sheet, and they prove their new carbon decarbonization platform actually works.
Yeah. The shift from a simple ethanol maker to a low CI fuel company has given them this potential $188 million annual earnings stream. And the big question for you as an investor is whether the market is finally going to start pricing in that potential now that the debt risk is fading. Or will it keep discounting the company because of the execution risk of the pipeline and the political risk of the tax credit?
That potential future earnings power is really the whole story.
It is. It makes GPRE a far more complex and potentially rewarding story than just another commodity producer.
Thank you for joining us for this deep dive. As always, the information we talked about is for informational purposes only and is not financial advice.